You know what might be the most expensive financial decision you'll ever make? It's not buying a bad stock. It's not timing the market wrong. It's buying a house you can't really afford and calling it an investment. After managing $11 trillion for nearly 50 years, I've watched millions of people trap their wealth in concrete and drywall, thinking they're building financial security, when they're actually creating their biggest liability. Before we go any deeper, I want to ask you something. If this conversation challenges the way you think about one of the biggest financial decisions of your life, do me a favor, hit that like button and subscribe to the channel. Turn on notifications. Because what we're about to discuss goes against almost everything you've been told about building wealth in America, and you're going to want to come back to this. I'm Larry Fink. I've been in this business since 1976, when I showed up on Wall Street wearing the world's ugliest brown suit, sporting long hair and turquoise jewelry. I looked ridiculous. But I was hungry, and I was curious about how money really works. Today, I run BlackRock, the largest asset management firm in the world. We manage assets for pension funds, sovereign wealth funds, endowments, and millions of individual investors trying to build financial security. And over these 5 decades, I've seen patterns. I've seen what works and what doesn't. I've seen how wealth is really built, and I've seen how it gets destroyed. And here's something that keeps me up at night. The single biggest wealth trap in America isn't in the stock market. It's in the real estate market. More specifically, it's in how we've been conditioned to think about homeownership. Let me be very clear about something up front. I'm not here to tell you whether to buy a house or rent. I'm not here to give you real estate advice. What I am here to do is challenge the framework through which you're making that decision. Because if your framework is wrong, your decision will be wrong, no matter how much research you do. We're going to talk about something that makes people deeply uncomfortable. We're going to question one of the most sacred assumptions in personal finance. That buying a home is always a good investment, that homeownership is the path to wealth, that renting is throwing money away. These aren't just financial beliefs. They're cultural narratives. They're woven into the American dream itself. And that's precisely why they're so dangerous. When something becomes culturally unquestionable, when it becomes part of our identity, we stop thinking critically about it. We stop doing the math. We stop asking whether it actually makes sense for our specific situation, our specific timeline, our specific financial goals. Here's what I've learned managing trillions of dollars. Every financial decision, no matter how emotional, no matter how culturally significant, comes down to mathematics and opportunity cost. Not feelings. Not what your parents did. Not what your neighbors think. Math and opportunity cost. And when you run the actual numbers on homeownership versus investing that same capital in financial assets, when you account for all the hidden costs that real estate absorbs, when you factor in the opportunity cost of having hundreds of thousands of dollars locked in an illiquid asset, the picture that emerges is radically different from what most people believe. I want you to think about something for a moment. When someone tells you they bought a house for $400,000 and sold it 10 years later for $600,000, they say they made $200,000. They feel wealthy. They feel smart. But did they actually make $200,000? Or is that just a story we tell ourselves? Let's think about what really happened. They put down $80,000, maybe $100,000. They paid $150,000 to $200,000 in mortgage interest over those 10 years. They paid $30,000 to $40,000 in property taxes. They spent $20,000 to $30,000 on maintenance, repairs, and insurance. They paid $30,000 to $40,000 in transaction costs, realtor fees, closing costs when they bought and sold. Suddenly, that $200,000 gain starts to look very different. But here's the part that almost nobody calculates, the part that institutional investors obsess over. The opportunity cost. What if they'd taken that $80,000 to $100,000 down payment and invested it in a diversified portfolio of stocks? What if they'd taken all those monthly costs, the portion that went to interest, taxes, maintenance, and invested that money instead? Over 10 years, in a market that's averaged around 10% annually, that capital could have grown to $300,000, $350,000, maybe more. And it would have been liquid. They could have accessed it if they needed it. They could have rebalanced it as markets change. They could have tax loss harvested. They would have had flexibility. But instead, that wealth was trapped. Locked inside walls and a roof. Illiquid. Inflexible. Subject to local real estate market conditions they couldn't control. Now, I can already hear what some of you are thinking. But Larry, I need a place to live. I have to pay for housing either way. So isn't it better to build equity than to pay rent? And that's exactly the question we need to examine. Because embedded in that question are assumptions that may or may not be true. The assumption that building equity is always better than having liquidity. The assumption that the total cost of ownership is comparable to the cost of renting. The assumption that real estate in your specific market will appreciate meaningfully. The assumption that you won't need to move for career opportunities. The assumption that you can handle a major repair expense. The assumption that you're correctly calculating the full cost of ownership. These assumptions, they sound reasonable. They feel true. But when you're making a decision that will lock up 30% to 50% of your net worth for decades, feelings aren't enough. We need to look at systems. We need to look at second-order effects. We need to look at what professional investors actually do with their capital. Here's something fascinating. You know what most truly wealthy people do? They rent their primary residences. Or if they own, they think about that property completely differently than the average American thinks about homeownership. They view it as a consumption decision, not an investment decision. They might own a home for lifestyle reasons, for stability, for their family, but they don't confuse that with wealth building. Their actual wealth, the capital they're using to compound their net worth, that's in financial assets. That's in businesses, in stocks, in bonds, in alternative investments. That's in assets that can scale, that can compound, that aren't tied to one geographic location. And there's a reason for that. It's not that they're smarter than everyone else. It's that they understand something fundamental about how capital works. They understand liquidity. They understand diversification. They understand opportunity cost. They understand that your primary residence, no matter how much it appreciates, is not an efficient wealth-building vehicle. Let me tell you what I see when I look at the typical American household's balance sheet. I see 60%, 70%, sometimes 80% of their net worth tied up in their house. One asset, one geographic location, one sector of the economy. If that house doesn't appreciate, if that local market struggles, if they need to move for a job, their entire financial situation is compromised. That's not diversification. That's concentration risk. That's exactly what we tell institutional investors never to do, and yet it's what most Americans are encouraged to do with the bulk of their wealth. And here's the thing. This isn't about intelligence. It's not about financial literacy, exactly. It's about framework. It's about the mental model you're using to make the decision. Most people are using a cultural narrative framework. Everyone should own a home. It's the American dream. It's how you build wealth. Renting is throwing money away. That's a narrative, not an analysis. What I'm asking you to do today is to step outside that narrative and think like an institutional investor. Think like someone who manages capital professionally. Think probabilistically. Think about opportunity cost. Think about liquidity. Think about diversification. Think about your human capital, your ability to earn money over time, and how geographic flexibility might impact that. Think about the full lifecycle cost of homeownership. This isn't about reaching a predetermined conclusion. This isn't about me telling you, never buy a house, or always rent. That would be just as simplistic as the narrative I'm challenging. What this is about is giving you a framework to make a more informed decision, a decision based on your specific circumstances, your specific timeline, your specific opportunity set. Because here's what I've learned in 5 decades, there's no universal right answer in finance. There are only frameworks for thinking clearly about trade-offs. And the trade-offs around homeownership are far more complex than most people realize. Over the next hour, we're going to walk through those trade-offs systematically. We're going to look at the real cost of homeownership, not the simplified version you hear about, but the full picture. We're going to look at the opportunity cost of capital. We're going to look at different life stages and career paths and when homeownership might make sense versus when it might be a trap. We're going to look at how professional investors think about real estate differently from how they think about their operating businesses or their investment portfolios. And most importantly, we're going to talk about something that almost never gets discussed: the psychological cost of homeownership, the stress of a large mortgage, the inflexibility when career opportunities arise, the burden of maintenance and repairs, the pressure of being house poor, where your home consumes so much of your resources that you can't invest in your own growth, in your skills, in your earning potential, in the financial assets that actually compound wealth over time. I've spent my entire career studying how wealth is built and preserved. I've worked with the world's largest investors, the most sophisticated capital allocators on the planet. And I can tell you this: none of them, not one, built their wealth primarily through homeownership. They built it through owning productive assets. Businesses, stocks, bonds, real estate investment trusts, yes, but not their primary residence. Assets that generate cash flow. Assets that scale. Assets that compound. Your home doesn't do that. Your home is where you live. It might appreciate. It might not. It provides shelter and stability, and those things have value. But confusing consumption with investment, confusing a place to live with a wealth-building strategy, that confusion has cost the average American family hundreds of thousands, sometimes millions of dollars in opportunity cost over their lifetime. And the tragedy is, most people never realize it. They retire with a paid-off house and think they've achieved financial security. And then they realize they don't have enough liquid assets to fund their retirement. They're house rich and cash poor. They can't access their home equity without selling and moving, or taking on debt in retirement. They've spent 30 years building wealth in the least efficient, least liquid, most concentrated form possible. That doesn't have to be your story. But it won't be your story only if you're willing to question the narrative. Only if you're willing to think differently. Only if you're willing to examine your assumptions and run the actual numbers for your actual situation. So here's what I'm asking you to do right now. Set aside what you've been told. Set aside what your parents did. Set aside what feels comfortable or familiar. And think with me. Think critically. Think like an institutional investor who has to justify every capital allocation decision, who has to think about opportunity cost, who has to optimize for long-term wealth creation, not short-term emotional comfort. Because this decision, whether to buy a home and when and how much to spend on it, this decision will shape your financial life for decades. It will determine how much capital you have available for true wealth-building investments. It will determine your geographic flexibility and career trajectory. It will determine your ability to weather financial storms. It will determine whether you retire with confidence or with anxiety. That's what's at stake, not whether you have a nice kitchen or a backyard. Those things are great, and if you can afford them without compromising your financial future, wonderful. But if pursuing homeownership means sacrificing your ability to build real wealth, if it means trapping your capital in an illiquid asset when you could be compounding it in financial markets, if it means taking on stress and inflexibility and opportunity cost that will haunt you for decades, then we need to talk about it honestly. And that's what we're going to do. Honestly, systematically, without judgment, but also without accepting conventional wisdom just because it's conventional. Let's begin. Let me start by giving you some context that changes everything about how we should think about housing as an investment. Context that most people never consider when they're signing a 30-year mortgage. In 1976, when I started on Wall Street, the average home in America cost about $44,000. Today, it's around $420,000. That's nearly a 10x increase. And people look at that and think, see? Real estate is a great investment. But let's think about what else happened during that same period. The S&P 500 in 1976 was around 100. Today, it's over 4,500. That's a 45x increase. Not 10x. 45 times. And that's before we factor in dividends, which would push the total return even higher. So yes, housing appreciated. But it dramatically underperformed financial assets over the same period. Now, you might say, but Larry, I need a place to live. I can't live inside a stock portfolio. And you're absolutely right. But that's exactly my point. Housing is consumption. It's a place to live. And there's nothing wrong with that. The problem is when we confuse consumption with investment, when we convince ourselves that the most expensive thing we'll ever buy is also our smartest financial move. Let me tell you how institutional investors think about real estate. When BlackRock evaluates a real estate investment, we're looking at several things. We're looking at cash flow. We're looking at the cap rate, the yield we're getting on our invested capital. We're looking at replacement cost. We're looking at demographic trends, employment growth, supply and demand dynamics. We're looking at our ability to exit the investment, liquidity. We're treating it as a business decision, a capital allocation decision. Your primary residence doesn't meet any of those criteria. It doesn't generate cash flow. It consumes cash flow. It doesn't provide a yield. It has a negative yield when you factor in all the costs. You can't easily exit it. It's highly illiquid. You're not diversified. You own one property in one location. And most critically, you're not thinking about opportunity cost because you've been told this is just what you're supposed to do. Let me break down what I call the hidden wealth drain of homeownership. And I want to be very specific here because this is where the math gets uncomfortable for a lot of people. Let's say you buy a $500,000 house. You put down 20%, which is $100,000. You take out a $400,000 mortgage at 7% interest over 30 years. Your monthly mortgage payment is about $2,660. But that's just the beginning. You've got property taxes. In the United States, the average effective property tax rate is about 1% of home value annually. That's $5,000 a year, $416 a month. You've got homeowners insurance, which nationally averages about $1,500 to $2,000 a year. Let's call it $150 a month. You've got maintenance and repairs. The general rule is to budget 1% to 2% of home value annually. Let's be conservative and say 1%. That's $5,000 a year, another $416 a month. Now we're at $3,642 a month in total housing cost. And we haven't talked about WA fees if you have them, or utilities, or the cost of furnishing a larger space, or the opportunity cost of the time you'll spend on maintenance and repairs. But here's the critical piece that almost nobody factors in: the opportunity cost of that $100,000 down payment. If you'd invested that $100,000 in a diversified portfolio averaging 10% annually in 30 years, that would grow to about $1.75 million. But instead, it's locked in your house, growing much more slowly, if at all. Now let's say you're paying $3,642 a month in total housing costs. You could rent a comparable property for, let's say, $2,500 a month. That's $1,142 less per month. If you invested that difference, that's another $13,704 per year. Over 30 years, at 10% annual returns, that's another $2.4 million. So the opportunity cost of buying instead of renting, in this scenario, is nearly $4 million over 30 years. $4 million. That's not a small rounding error. That's the difference between a comfortable retirement and an extraordinary retirement. That's the difference between financial independence and financial stress. But wait, you say. What about the appreciation of the home? Fair question. Let's say your $500,000 home appreciates at 3% annually, which is roughly the historical average for U.S. housing. In 30 years, it's worth about $1.2 million. You've paid off your mortgage, so you own it free and clear. Sounds great, right? But remember, you started with $100,000 down plus you paid $400,000 in mortgage principal over 30 years. That's $500,000 of your money. It grew to $1.2 million. That's a 2.4x return over 30 years, or about 3% annually. Meanwhile, the S&P 500 historically returns about 10% annually, which would have turned that same $500,000 into over $8 million. And we still haven't factored in all the interest you paid. On a $400,000 mortgage at 7% over 30 years, you'll pay approximately $560,000 in interest alone. That's money that went to the bank, not into your home equity. That's another opportunity cost. When you add it all up, when you account for every dollar that went into that house versus every dollar that could have been invested in financial assets, the gap is staggering. We're talking about millions of dollars in foregone wealth for the average American household over their working lifetime. Now, I know what some of you are thinking. You're thinking, but those numbers assume everything goes perfectly. What about market crashes? What about volatility? Isn't my house safer? Let me address that head on, because it's a critical psychological barrier. Housing feels safer than stocks because you don't see the price every day. You don't get a notification on your phone telling you your house value dropped 2% today. That psychological comfort, that lack of daily price transparency, it makes people feel like real estate is less volatile than stocks. But it's not. It's just less frequently measured. In the 2008 financial crisis, housing prices fell 30% to 40% in many markets. Some markets fell even more. That's comparable to stock market crashes. The difference was, when stocks fell, they recovered relatively quickly. The S&P 500 was back to its pre-crisis highs by 2013. Housing took longer in many markets. Some didn't fully recover until 2016 or 2017. And during that entire period, you still had to pay your mortgage, your property taxes, your insurance, your maintenance. The cash drain never stopped. If you'd been invested in diversified stocks, yes, you would have seen your portfolio value drop. It would have been painful. But if you'd held on, if you'd continued investing through the crisis, you would have recovered and then some. And critically, you would have had flexibility. You could have moved for a job opportunity. You could have accessed your capital if you needed it. You weren't trapped. This is what I mean by thinking systemically. It's not just about which asset class has the better long-term returns, although that matters. It's about liquidity, flexibility, diversification, and opportunity cost. It's about how that decision affects every other aspect of your financial life. Let me tell you about a pattern I've observed over decades. The people who build significant wealth, who achieve financial independence, they tend to do something counterintuitive. They live below their means in housing so they can invest above their means in financial assets. They rent, or if they buy less house than they can afford. They take the difference between what they could spend on housing and what they actually spend, and they invest that difference aggressively. They understand that every dollar trapped in their house is a dollar that's not compounding in their investment portfolio. They understand that their primary residence is a lifestyle decision, not a wealth-building strategy. Now, does that mean you should never buy a house? Of course not. There are scenarios where homeownership makes sense. If you're going to stay in one location for a very long time, 15 years or more, the transaction costs get amortized and the math starts to look better. If you're in a market where the ratio of home prices to rents is relatively low, maybe 15-1 or less, buying might make sense. If you've already built significant wealth in financial assets and you want to buy a home for lifestyle reasons, fully understanding it's a consumption decision, go ahead. But those aren't the typical scenarios. The typical scenario is someone in their late 20s or early 30s, just starting to build wealth, taking on a massive mortgage that will define their financial life for the next 3 decades. Someone who might need to move for career opportunities. Someone who could be earning much higher income in 5 or 10 years but has locked themselves into a fixed housing payment. Someone who could be compounding wealth aggressively in their peak earning years but instead is pouring money into mortgage interest and property taxes. That's the trap. And it's a trap that's reinforced by everyone around you. Your parents want you to buy. Your friends are buying. Social media is full of people showing off their new homes. Real estate agents are telling you it's a great time to buy. Mortgage brokers are telling you how much house you can afford, which really means how much debt they can convince you to take on. But nobody's asking you the most important question. What's the opportunity cost? What else could you do with that capital? How might your life and career evolve over the next decade? What financial flexibility are you giving up? What investment returns are you sacrificing? I've seen this play out thousands of times. Someone buys a house at 28 years old. By 35, they've gotten a great job opportunity in another city, but they can't take it because they'd lose money selling their house. Or they can take it, but they have to rent out their house and become a long-distance landlord, dealing with tenants and maintenance from across the country. Or they sell at a loss and feel like they made a terrible financial mistake. Or they stay in their job, in their city, because of the house. And they wonder, 10 years later, where their career could have gone if they'd had the flexibility to take that opportunity. This is what I mean when I talk about the hidden costs of homeownership. It's not just the money. It's the opportunity cost of your career. It's the stress of being over-leveraged. It's the inflexibility when life changes, because life always changes. At BlackRock, when we think about risk management, we think about optionality. We want to maintain the ability to adjust as circumstances change. We want liquidity. We want flexibility. We don't want to be locked into positions we can't exit without significant cost. Your primary residence is the opposite of that. It's a massive, concentrated, illiquid position. It's the antithesis of what professional investors do with their capital. Now, I want to address something directly, because I know this conversation makes some people uncomfortable. Some of you own homes. Some of you have mortgages. And you might be feeling defensive or anxious hearing this. That's not my intent. I'm not suggesting you made a wrong decision. Every financial decision has to be evaluated in context, in the circumstances you were in when you made it. What I am suggesting is that going forward, you think about this differently. You think about your home as consumption, not investment. You don't count on it as your primary wealth-building vehicle. You focus your actual wealth-building efforts on accumulating financial assets, diversified portfolios that will compound over time. And if you're younger, if you haven't bought yet, I'm suggesting you question the narrative. I'm suggesting you run the numbers for your specific situation. I'm suggesting you think about opportunity cost. I'm suggesting you consider whether renting and investing aggressively might leave you wealthier in 20 or 30 years than buying and being house poor. Because here's what I've learned in 5 decades managing capital. Wealth is built through ownership of productive assets that scale and compound. Your job is a productive asset, your ability to earn income. Businesses are productive assets. Stocks are ownership in productive businesses. Bonds provide yield. These things build wealth. Your primary residence is consumption. It might appreciate, but that appreciation barely keeps up with inflation historically. It's not generating cash flow. It's not compounding. It's not making you wealthier in any real sense. It's providing shelter, which has value, but let's not confuse that with wealth building. The wealthiest people I know, they understand this distinction. They live in nice homes, sure. But those homes are not where their wealth is. Their wealth is in their businesses, their investment portfolios, their diversified holdings. The home is where they live, not how they build wealth. And that's the framework I want you to adopt. Not because I'm against homeownership. I'm against confused thinking. I'm against people making the biggest financial decision of their lives based on cultural narratives instead of clear-eyed analysis. I'm against people trapping their wealth in illiquid assets when they could be building real, compounding, flexible wealth in financial markets. That's what we need to talk about next. How to actually build that wealth. How to think about housing as one expense among many, not as your primary investment strategy. How to structure your financial life for maximum flexibility and growth, not maximum house. Let's keep going. So let's bring all of this together. Let's talk about how to actually think about this decision. Not what to do, because I can't tell you what to do. Your situation is unique. Your priorities are yours. But I can give you a framework for thinking clearly about one of the most important financial decisions you'll ever make. First, let me give you the mental models that institutional investors use when evaluating any major capital allocation decision. These same models apply to your housing decision. Mental model number 1. Every dollar has an opportunity cost. When you put a dollar into your house, you're not putting it into something else. That something else might have generated better returns, provided more flexibility, or created more optionality for your future. You need to think about what you're giving up, not just what you're getting. I've seen this blind spot destroy wealth over and over again. Someone puts $100,000 into a down payment and thinks, great, I'm building equity. They're not thinking about what that $100,000 could have become over 30 years in a diversified portfolio. They're not thinking about the difference between $100,000 growing at 3% in home equity versus 10% in financial assets. That's the difference between $240,000 and $1.75 million. That's not a small oversight. That's a life-changing miscalculation. Mental model number 2. Liquidity is power. In an uncertain world, flexibility is one of the most valuable assets you can have. Cash and liquid investments give you options. They let you take advantage of opportunities when they arise. They let you weather storms without being forced to make terrible decisions. They let you move, pivot, adjust as life changes. A house is the opposite. It's illiquid. You can't sell 10% of it when you need cash. You can't easily exit if circumstances change. You're locked in. And in a world that's changing faster than ever, where career paths are unpredictable, where opportunities emerge suddenly, where industries rise and fall in years not decades, being locked in is dangerous. I've managed capital through multiple cycles now. The 1987 crash, the dot-com bubble, 9/11, the financial crisis, the European debt crisis, the pandemic. And you know what I've learned? The investors who thrive aren't the ones who made perfect predictions. They're the ones who maintained flexibility. The ones who had dry powder when opportunities appeared. The ones who could adjust their strategy when circumstances change. Your housing decision determines how much flexibility you'll have for the next several decades of your life. Think about that carefully. Mental model number 3. Diversification isn't just about assets. It's about risk. When 60%, 70%, 80% of your net worth is tied up in one asset, in one geographic location, in one sector of the economy, you're not diversified. You're concentrated. And concentration is risk. Professional investors would never allow that level of concentration in a portfolio we manage. We'd be violating our fiduciary duty. We'd be exposing our clients to unnecessary risk. But somehow, when it comes to personal real estate, this concentration is not only accepted, it's encouraged. It's celebrated. That doesn't make it smart. It makes it culturally normalized. There's a difference. Mental model number 4. Distinguish between consumption and investment. This is critical. Consumption is spending money on things that provide immediate utility but don't build wealth. Investment is deploying capital into assets that will grow and generate returns over time. Your primary residence is primarily consumption. Yes, it might appreciate. But that appreciation is secondary to its primary function, which is providing shelter. The appreciation barely keeps up with inflation historically. The cash flow is negative. The diversification is non-existent. The liquidity is terrible. If you want to invest in real estate, buy REITs. Buy shares in diversified real estate portfolios managed by professionals. Get exposure to commercial real estate, industrial real estate, multifamily residential. Get the benefits of real estate appreciation without the concentration risk, without the illiquidity, without the negative cash flow. But don't confuse buying a place to live with building wealth. They're different things. And when you confuse them, you make suboptimal decisions. Mental model number 5. Think in lifecycle terms. Your financial needs and priorities change as you age. Your career trajectory changes. Your family situation changes. Your risk tolerance changes. Your liquidity needs change. A housing decision that makes sense at 45 might be terrible at 28. A housing decision that makes sense when you're certain you'll stay in one city for 20 years might be disastrous if there's any chance you'll need to move. At BlackRock, when we construct portfolios for clients, we think about their entire life cycle. We think about accumulation phase, peak earning years, pre-retirement, retirement, legacy planning. We adjust the strategy for each phase. We don't use one-size-fits-all solutions. Your housing strategy should be the same. When you're young, when you're building your career, when you're accumulating capital, flexibility and aggressive investment in financial assets might be more important than homeownership. When you're older, when you're more established, when you've already built substantial wealth in financial assets, buying a home for lifestyle reasons might make perfect sense. But most people do the opposite. They buy early, when they can least afford to lock up their capital and sacrifice flexibility. And then later, when they could easily afford it, they're already locked in. Now, let me talk about something we haven't addressed yet. The psychological dimension. Because I know that for many of you, this entire conversation has been uncomfortable. Housing isn't just a financial decision. It's tied up with identity, with family, with cultural expectations, with your vision of success and stability. And I understand that. I really do. I've seen it in my own family, my own friends. The pride of homeownership, the feeling of having made it, the desire to provide stability for children. These are real, legitimate emotional needs. But here's what I've also seen. The stress of being over-leveraged. The anxiety of house-poor families who can't take vacations, can't invest in their children's education, can't handle an unexpected expense without panic. The trapped feeling when career opportunities arise but can't be pursued. The marital stress when money is constantly tight because too much is going to housing. Financial stress destroys quality of life. It destroys relationships. It destroys health. And often, that stress comes from having too much house, from treating housing as an investment rather than a lifestyle decision that should fit comfortably within your budget. So here's what I want you to think about. What if you approached housing differently? What if you decided that you'd spend no more than 20% or 25% of your gross income on housing, whether that's rent or mortgage? What if you took the difference between what you could spend on housing and what you actually spend, and you invested it aggressively? What if you rented a comfortable but modest place, and you put $2,000 or $3,000 or $5,000 a month into a diversified portfolio of index funds? What if you did that for 10 years, 15 years, 20 years? Let me tell you what would happen. You'd build real wealth, liquid wealth, flexible wealth, wealth that gives you options, wealth that compounds, wealth that's diversified across thousands of companies in multiple sectors and geographies. And then, if you still want to buy a house, you could. But you'd be buying from a position of financial strength, not financial strain. You'd be buying because you choose to, not because you feel like you have to. You'd be buying with cash or a small mortgage, not a massive debt that will define your financial life for decades. That's a very different position to be in. That's freedom. That's optionality. That's what wealth actually looks like. I've spent nearly 50 years in this business. I've seen every kind of market, every kind of economic environment, every kind of financial decision. And here's what I can tell you with confidence. The people who achieve financial independence, who build lasting wealth, who have options and flexibility and security, they're not the people who bought the biggest house they could afford. They're the people who lived modestly relative to their income and invested aggressively in productive assets. They're the people who understood that wealth comes from owning pieces of growing businesses, not from owning the place where they sleep. They're the people who thought clearly about opportunity cost and made decisions based on math, not emotion or cultural pressure. And they're the people who, when they did eventually buy homes, bought them for the right reasons. Not as investments, not to keep up with neighbors, not because they felt like they should, But because they'd already built substantial wealth, and they wanted a particular lifestyle, and they could afford it comfortably without sacrificing their financial future. Now, I want to give you some very practical guidance as we close this out. If you're thinking about buying a house, here are the questions you need to ask yourself. Not what I think you should do, but questions that will help you think clearly about your specific situation. Question 1. How long do I expect to stay in this location? If it's less than 7 to 10 years, the transaction costs of buying and selling will likely eat up any appreciation. The math probably doesn't work in your favor. Question 2. If I put my down payment and ongoing housing costs into diversified investments instead, what would my net worth likely be in 20 or 30 years? Run the actual numbers. Be honest about all the costs of homeownership. Compare that to renting and investing the difference. Question 3. What's my career trajectory? Is there a realistic chance I might need to move for a job opportunity? Am I in an industry or profession where geographic flexibility matters? If yes, how much is that flexibility worth? Question 4. What percentage of my net worth would be tied up in my house? If it's more than 40% or 50%, you're very concentrated. Is that risk worth it? Question 5. Can I comfortably afford this house and still invest aggressively in financial assets? If buying a house means you can't save and invest at least 20% to 25% of your income, you probably can't afford the house, even if the bank says you can. Question 6. Am I buying this house for lifestyle reasons I fully understand and accept, or am I buying because I think it's a good investment? If you're buying because you think it's a good investment, you need to revisit the math. If you're buying for lifestyle reasons you've thoughtfully considered, that's different. These questions don't lead to a single right answer. They lead to clarity, and clarity is what you need to make a good decision. Let me close with this. I'm not anti-homeownership. I'm pro-clear thinking. I'm pro-understanding what you're actually doing with your capital. I'm pro-making decisions based on your specific situation, not on cultural narratives or family pressure or what your neighbor is doing. If you're young, if you're building your career, if you're accumulating capital, I'd strongly encourage you to consider whether renting and investing aggressively might serve you better than buying. Not because renting is inherently superior, but because at that life stage, flexibility and aggressive wealth accumulation might be more important than homeownership. If you're more established, if you've already built substantial wealth in financial assets, if you're certain about your location, if you want a house for lifestyle reasons and can afford it comfortably, buy the house. Just be clear with yourself that it's a consumption decision, a lifestyle decision, not your primary wealth-building strategy. Your wealth gets built through ownership of productive assets. Through your career, your human capital. Through stocks, bonds, businesses. Through diversified portfolios that compound over time. That's where you should focus your financial energy. Housing is important. A home provides shelter, stability, a place to build memories with family. Those things matter. But they're separate from wealth building. Don't confuse them. Over these last few minutes, we've covered a lot of ground. We've challenged some deeply held assumptions. We've looked at numbers that many people never calculate. We've thought about opportunity cost, about liquidity, about diversification, about life cycle planning. My goal wasn't to tell you what to do. My goal was to give you a framework for thinking more clearly about one of the biggest financial decisions you'll make. A framework based on how professional investors actually think about capital allocation, risk management, and long-term wealth building. Take that framework, apply it to your specific situation. Run the numbers honestly. Think about your priorities, your timeline, your career path, your risk tolerance. And then make a decision that's right for you, based on clear thinking, not on narratives or pressure or assumptions you've never questioned. Because that's how wealth gets built. Not through following conventional wisdom. Not through doing what everyone else does, but through thinking clearly, acting deliberately, and making decisions aligned with your actual goals and circumstances. If this conversation changed the way you think about housing and wealth, I want you to do something for me. Share this video with someone who's thinking about buying a house. With someone who's struggling with a mortgage. With someone who needs to hear that there's a different way to think about this. Because these ideas, they're not commonly discussed. They go against the grain. But they're based on 5 decades of experience managing capital at the highest level. And join this community. Subscribe to the channel. Hit that notification bell. Because we're going to keep having these conversations. We're going to keep challenging conventional wisdom. We're going to keep thinking about how to build real, lasting wealth in a world that's constantly trying to separate you from your money. The path to financial independence isn't complicated. But it requires clear thinking. It requires distinguishing between consumption and investment. It requires understanding opportunity cost. It requires the courage to do what makes sense for you, even if it's different from what everyone else is doing. You can do this. You can think clearly. You can make smart decisions. You can build real wealth. But it starts with being willing to question assumptions, to run the numbers, to think like an institutional investor thinks about capital. That's what separates people who achieve financial independence from people who struggle. Not intelligence, not luck, clear thinking and disciplined execution. Go forth and think clearly. Your future self will thank you.